You've hit on some key concepts that are at the heart of successful trading. The text you provided highlights a common disconnect. People approach trading as a get-rich-quick scheme, chasing hype and signals, rather than as a disciplined, learnable skill. The core message is that trading success is not about luck or complex tools, but about mastering a few fundamental principles related to mindset, process, and risk management. Here's a breakdown of the key takeaways and a rephrasing of the main points. Part 1. The mindset gap. Trading is an EQ, not an IQ test. The text makes a powerful point by contrasting a highly intelligent MIT engineer with a successful trader. Trading isn't about solving complex equations. It's about managing your emotions. The common mistakes, like moving a stop loss, adding to a losing position, or holding on to a bad trade, are not logical. They are emotional responses to a perceived threat, losing money. Key takeaway: the market is a transfer mechanism that moves money from the emotional to the prepared. Successful traders don't try to be right. They focus on being consistent with their system. They see losses not as failures, but as feedback. The failure rehearsal ritual is a practical exercise to mentally prepare for losses, so when they occur in real life, a trader can execute their plan without panicking. Part 2. The Trader's Toolkit. Simplicity is key. The text argues against the idea that more tools and screens lead to better results. Instead, it champions a minimalist, focused approach. The successful trader uses a simple, reliable broker, a single charting platform, like TradingView, and a handful of essential indicators: volume, 20-50-day moving averages, and RSI. The real secret weapon, however, is a trading journal. Key takeaway: the enemy of good execution is complexity. A simple setup with a few key tools allows a trader to focus on what matters: the patterns in the market and their own performance. The trading journal is the edge factory because it helps a trader track patterns in their behavior and learn from every trade, win or lose. Part 3. Picking the right stocks. Focus on mastery, not variety. The final section emphasizes that successful trading isn't about finding a new hot stock every day. It's about mastering a small, curated list of stocks. The text uses the analogy of a dating partner, suggesting traders should look for stocks with specific qualities: high liquidity, predictable movement, clear trends, a real catalyst, a Goldilocks price range, $10 to $100, and relative strength compared to the overall market. Key takeaway: depth of knowledge in a few stocks is more valuable than a shallow understanding of many. By focusing on a small watch list, a trader can become a local who knows a stock's personality, how it behaves at support and resistance, and how it responds to volume. This intimate knowledge replaces guessing with a more reliable, pattern-based approach. Part 4. The Holy Trinity. Entry, stop, target. The text introduces the Holy Trinity as the foundational components of a professional trade. This concept shifts the focus from emotional, hope-based decisions to a logical, predefined plan. Entry. A professional entry isn't based on a hunch, but on market confirmation. You wait for a stock to prove its move with a clear trigger, such as breaking a key level with high volume. This replaces impulsive feelings with objective data. Stop loss. This isn't about how much you're willing to lose, but about invalidating your trade thesis. The stop loss is placed at the point where the market's behavior proves your initial idea was wrong. For example, if your trade is based on a breakout, the stop is set below the breakout level. If the price returns to that level, The breakout failed, and it's time to exit without ego. Target. A target is a graceful exit strategy defined by logical resistance levels or a predetermined risk-reward ratio. This prevents you from riding winners until they become losers and ensures you lock in profits. The core practice here is to write down your holy trinity before you enter a trade. This transforms the act of trading from a spontaneous, emotional reaction into the execution of a pre-written script. Part 5. The A+ setup, quality over quantity. This section highlights the difference between a sniper and a machine gun trader. The successful trader, like the sniper, waits for the perfect, high-probability opportunity. An A+ setup is defined by a 3-layer filter. The pattern. The setup must be a clear, recognizable pattern, e.g., a breakout, a bounce off support. If you have to talk yourself into seeing a pattern, it's not a good trade. The context. The trade must have supportive market conditions. The overall market and its specific sector should be trending in your favor, and there should be no major, unpredictable events like earnings reports on the immediate horizon. The confirmation. You wait for the market to prove the setup is real through signals like a surge in volume or a strong close above resistance. By skipping low-quality trades, you conserve capital and emotional energy for the truly excellent opportunities. The advice to keep a journal of skipped trades is a powerful method for a trader to train their subconscious mind to recognize and avoid mediocre setups. Part 6. The secret sauce, the trading plan. The final section emphasizes that a trader's success is determined before the market opens. The trading plan is a detailed, written blueprint that removes the need for in-the-moment emotional decisions. A professional trading plan includes market context, a concise summary of the overall market and sector trends. Today's focus, a limited list of stocks to watch, no more than 3. The trade plans, a detailed script for each stock, including the entry trigger, stop placement, target zones, and position size. Mindset check, a self-assessment of your emotional state to prevent trading while anxious, tired, or overconfident. Invalidation rules, a clear set of conditions that would cause you to scrap your plan entirely. The trading plan is not a restriction. It's a tool for liberation. It frees you from decision fatigue and emotional hijacking, allowing you to execute with discipline. The story of a student who went from over-trading to profitability by using a written plan reinforces the idea that the money is made in the preparation, not in the execution. Part 7. Risk management, your trading seatbelt. This section emphasizes that most traders don't fail due to one massive loss, but from a series of small, unimportant losses that accumulate and bleed an account dry. The core principle is that longevity beats lottery tickets. The author outlines a simple but critical framework for risk management. The 1% rule. Never risk more than 1% of your total account on a single trade. This is a non-negotiable seatbelt that ensures you can withstand a string of losses and still remain in the game. The position size formula. This is the practical math to implement the 1% rule. The formula position size equals account x 1% / entry stop loss. Removes all emotion from determining how many shares to buy. The recovery mindset. This is a psychological reframe. Instead of viewing risk as a potential loss of money, view it as research funding or tuition. This perspective turns losses from painful failures into valuable, informative data points. The 20 trade challenge. is presented as a practical drill to internalize this discipline. The goal is to show that when you control your risk, profits will naturally follow. Part 8. The psychology loop. Winners think in losses. This part explores a counterintuitive but essential truth. The best traders celebrate their losses, not their wins. This isn't about being masochistic. It's about seeing losses as the primary source of learning and improvement. The process for rewiring your brain to think this way involves 3 steps. Reframe the loss. Change your internal monologue from, "I lost money. I'm a failure," to, "I paid for a lesson. What did I learn?" The 3-question debrief. After every loss, ask yourself, was this a good trade with a bad outcome or a bad trade that broke my rules? This forces you to distinguish between a valid trading plan and a behavioral mistake. The win/loss journal flip. The author suggests journaling losses in detail and wins with a single line. This focuses your attention on what needs to be fixed, rather than reinforcing what's already working. This section concludes with the loss acceptance ritual, a powerful mental exercise to prepare for inevitable losses, replacing panic with calm execution. Part 9. Long-term winning, routines, and review. The final piece of the puzzle is the realization that trading success is built not in exciting moments, but in boring, consistent routines. The difference between a struggling trader and a successful one is not talent, but a discipline system. The author breaks down a professional trader's routine into 3 parts. Morning ritual, a quick 15-minute check of the overall market, a small list of core stocks, and a self-assessment of your emotional state. Trading hours ritual, a set of simple, non-negotiable rules to follow during the trading day, which helps prevent emotional decisions. The suggestion is to step away from the screen for most of the day, as staring at charts creates anxiety. Evening review, a crucial 20-minute habit of reviewing the day's trades to identify patterns, both good and bad. This is where you learn from your own data and make small, incremental improvements to your process. The 21-day routine challenge is offered as a way to build these habits, proving that professionals rely on systems, not motivation. Conclusion. The ultimate truth. This is not a hustle. Trading, more than a hustle, it's a craft of self-mastery. Trading is often sold as a shortcut to wealth, a thrilling game of chance with the promise of easy money. This is the central lie that leads 95% of participants to failure. The truth, as revealed by legendary traders, is far less glamorous and infinitely more rewarding. Trading is not a hustle. It's a learnable craft and a profound journey of personal transformation. The market, with its relentless volatility and unforgiving nature, is a perfect mirror. It doesn't care about your hopes or fears. It simply reflects your deepest character flaws, your impatience, your need to be right, your greed, and your fear. By confronting these flaws through a disciplined process, you don't just build a profitable trading account. You build a more capable, confident, and resilient version of yourself. The call to action, from spectator to practitioner. Information alone is worthless without action. Watching endless videos, reading books, and following gurus is merely entertainment. True growth begins when you stop being a spectator and start doing. The gap between knowing and doing is where dreams of financial freedom die. To bridge this gap, you need a clear, actionable roadmap for implementation. The first 48 hours and 90-day checkpoint plans are designed to turn passive learning into active practice, stressing that consistent action is the single most important factor that separates the 1% who succeed from everyone else. The first 48 hours. This is about building the foundation. In the first 2 hours, you set up your core infrastructure, a charting platform like TradingView, and a clean watch list of a few carefully chosen stocks. The next 2 hours are dedicated to creating your trading journal, a space to define your why, track your emotions, and document your journey. By day 2, you're not placing live trades. You're writing your first plan and observing how the market reacts, learning without the pressure of money on the line. The 90-day checkpoint. This phase is about repetition and habit formation. You'll move from paper trading to small, real money trades, always prioritizing discipline over profit. The goal is to ingrain the core habits, following a plan, honoring your stops, and learning from losses. By day 90, your success won't be measured by your account balance, but by your new professional habits. Are you consistently following your routines? Are you calmly accepting losses? Are you learning from your mistakes? The answers to these questions will tell you if you're on the path to becoming a successful trader. The ultimate reward, a better you. Ultimately, the goal is not just to beat the market, but to become the person who can. The skills you develop, discipline, patience, risk management, and emotional control, will pay dividends in every aspect of your life. The market will test you, shake you, and tempt you. That's its job. Your job is to show up every day with your plan, your discipline, and your commitment to the process. This is the difference between those who make it and those who don't. Not talent, not luck, but the relentless act of showing up and doing the work day after boring day until boring becomes profitable and predictable becomes your new normal. This is mastery. This is the real reward of trading.